versus liabilities. Okay, where are we starting? Assets and liabilities, right? So there are three things, right? In investing, you pretty much have to be cognizant all the time when you're investing. And those is like the distinction between assets, liabilities, and equities, right? Because pretty much if you fund my financial statements, that's pretty much what you're going to hear. Those about we about equities, those about assets in relation to equities. Sometimes people saying the stock is overpriced, or maybe they don't have assets to back the price. You understand? Or their assets are not generating enough cash. They're not using their assets to generate enough cash, right? All that jargon and all that talk, what does it mean? So let's break it down. I think the simplest thing or the simplest way to try and start to break it down will be putting it in a house format, right? So mounting in, right? If you buy a house, you usually buy a house using your own money, right? But you don't use your whole money for the full amount. So let's say in Libiza 5 million, right? And you have in your savings what 1 million. You have 1 million in your savings. Where are you gonna get the other 4 million, right? You're gonna finance it through a bank, or a bank. So the simplistic idea of it is that this million of it, this lily million lako, right? Okay, think of it as pants. 5 million is the asset, right? It's the total value of an asset, right? But then within an asset is divided into two parts, or it's financed in two ways, right? So it's financed with your own money, and it's also financed using the bank's money, right? Or using someone else's money. Usually it's a loan, of which it's equity. I mean, it's debt in this instance of what we call liabilities, because liabilities are usually debt, not even usually. Usually it's debt. It is payables as well. Like liabilities also include things like payables. Let's say maybe you are a spaza shop and you order stock and you ordered it in a you didn't pay your supplier, right? That amount, maybe stock was 50,000. That is a liability, right? It's squared. So pretty much it's squared. But right now, let us think of liabilities in the context of financing an asset, right? You're financing a house. A house costs 5 million, and when you only have 1 million, right? So you're gonna get the other 4 million from the bank. So that 4 million is your liability, right? So the same intuition sort of apply when it comes to investing, and it comes to companies, rather, right? And this specifically, when you look at the balance sheet, that's where uyibona kahle mawubuka i-balance sheet, because i-balance sheet sort of splits ama-assets, ama-liabilities, and the equity of a company, right? So I'll make an example. I have here. This is AVI, right? AVI is a company. They own a choice assorted. Well, funny enough, we just came back from a holiday at December, so they made a killing, not December. So money lama choice assorted. It's AVI. It's this company, and this is in no way, shape, or form promoting AVI. By the way, it's just one of the companies in the JSE, right? You do your research, but let's get back to the topic. So I'm saying, AVI, for example, this is their balance sheet, right? How does AVI balance sheet look, or looks rather? So this was what from 2024. So $13 something that's way old, probably wouldn't materialize that much in njengamanje, right? So I think everyone remembers accounting about the balance sheet, the balance and everything. Your assets must be equal to your liabilities and equity, right? So that's sort of the thinking behind it, right? And the thinking behind it now, like a minute ago, I just said a house costs 5 million, right? And when you have 1 million, and you're gonna borrow 5 or 4 million from the bank, right? So the total amount of financing is 5 million, right? Doesn't it make sense as well that a company's assets should be equal to its liabilities plus equity? Because if all of a sudden your equities plus liabilities is equal to 5.5 million, you will have a problem now. Zobuzo ukuthi, at like what's going on? I mean, I only wanted 5 million. Who's gonna pay for this other or additional 500,000? That's pretty much the intuition even behind the accounting, because accounting is the same thing for a person. I mean, yeah, for a person, just that it's done in the context of a company, right? So AVI, if we look at this, AVI has like non-current assets of 4.7 billion, 4.76 billion, right? Let's just drop AVI for now. Let's just call it the company. So this company has 4.7 billion, right? If you break it down, if you look at their non-current asset, because assets are broken down into two. There are two types of assets. There are non-current assets and current assets. So non-current assets, every asset that will stay within the company, or the company will use for more than 1 year. So think of like a chair. Think of the laptop that you use when you work. Think of the building, right? As you can see here, this is property, plant, and equipment. That's pretty much the umbrella that they use. Property is the building, plants, it's vehicles like motor, a factory as well. And then you have equipment, right? So that's usually the biggest. Usually for companies, that's usually the biggest item in terms of my assets. It's usually the biggest item because, I mean, it's buildings. If a company owns a building, it costs a lot of money, right? Equipment to run the building or that will be running in the building costs a lot of money. So non-current assets are usually the biggest ticket or the biggest line item. And then below that, you have right-of-use assets, right? Right-of-use assets are things like copyright, right? It's not a physical asset, right? But it's the right to use something. So think of it like a license, right? Not really. Let's do that. I mean, we're on YouTube and we're learning right now. Let's Google search. But a right-of-use asset represents a lessee's contractual right to control and use an identified asset like property, equipment, or vehicles over a lease term recorded on the balance sheet. Yeah, it's a lease. It's a lease. I don't know what happens. I don't know. You know, when you live, sort of your brain almost freezes. You know, the thought of would you live. I don't know. Maybe it's because I'm still starting out and I'm still nervous about stuff. So I still miss my word every now and then. But yeah, and then you have intangible assets and goodwill. Still, things like intangible assets are things like patents. You know, if you think of think of a company like a pharmaceutical company, for example. A pharmaceutical company, they file a lot of patents, right? So all those patents will go there. Will go here, intangible assets. And then also here you see investments in joint ventures. There is investments in other companies. So they make investments. Could be small investments, not a lot, right? And then you have other long-term assets, and then you have deferred tax. I won't be technical into what are these things, right? That's not the point. And then if you look at current assets, right? Current assets, they will be used by the company within 12 months. Inventory, right? Stock. If stock cannot be here after 6 months. We have to sell it. We have to sell it within 2 weeks, 3 weeks, right? Biological assets, other financial assets, current tax asset, but basically trade receivables. So there's something called trade receivables as well. So trade receivables are basically what your customers owe you. So if you die saying esquelate, you sell something to someone on credit rather, and they haven't paid, you put them there. They are called trade and other receivables. And then you have cash and cash equivalents. So that is basically let's say bank. So it could be cash. Maybe it's not a bank. A company has like 5 bank accounts. And if you put them all together, they make like 352 million, right? And then current assets are 5.5 billion, right? And then non-current assets are 4.7 billion. But then if you look at the total, it's like 10.3, right? Now let's focus. And then always remember the 5 million example of saying this 10 million, this 10.3 billion is equivalent to the 5 billion, to the 5 million example I made earlier of a house, right? It's the same. And maybe now with these assets could be, if non-current assets in your house could be a chair, could be your plate. I mean, plates last longer than a year, as long as engafi nje, at least. Ungenayingane ebulalayo and everything. But all of these things, you can sort of put them in the context of a house. Igrosa in the house, you use it within a month. So that's your current asset. But then if you look at the total, it's 10.3, right? And then now, if you look at equities, right? So we will, okay, look, before we get into equity, we talk about debt. So let's say now, how, think of it like this. How did this company finance these 10.3 billion assets? That's basically the point of it. Uguti, they have 10.3 billion assets, right? But how are they financed? Like, how much money did they put when they're buying a building? How much money did they put when they... But you won't see that in the granular scheme of things because, I mean, this is one page that simplifies a company that has a lot of buildings, right? But to sum it all up, right? If you say a building, a chair, a table, a printing machine, a pen, everything that's in the building. If you say we bought it for 10 rand, bought it cash, we bought this chair for 5,000, but we paid 2,000, we still owe 3,000. We bought this table for 10,000, but we paid 5,000, we still owe 5,000. So pretty much it's an aggregation. That's what you see when you see a financial statement like this, right? So then they say equity and liabilities. So equity and liability, so with balance sheet, they pretty much group them together, right? If you see here, total assets 10.3, equity and liabilities. So they make a separate section for it. So then you have total equity, which is 5.7 billion, right? So that's pretty much, this is pretty much the 1 million equivalent of the 5 million example I made earlier, right? To say, this is what, if you are a shareholder, right? If you are a shareholder of this company, you have 5 billion to share amongst yourselves. Why do you have 5 billion to share amongst yourselves? Not 10 billion of assets. Because remember, the company has 10 billion of assets. So why isn't it 10 billion? That is because this 10 billion of assets is also financed with 3.3 billion of current assets and 1.1 billion of non-current assets, right? I mean, of non-current liabilities. 1.1 of non-current liabilities and 3.375 of current liabilities, right? That's the difference. Hey, Sion, how's it, my bro? You see, you need to check me on YouTube, man. I keep telling you this. So yeah, I'm saying for assets and liabilities, what tends to happen is that they are differentiated into two. So assets are differentiated into non-current assets and current assets. Then liabilities as well are separated from non-current liabilities and current liabilities. So for example, think of it like this. A building that costs 20 million will be financed with a loan for 20 years, right? And then at the same time, or a company will borrow a loan for 20 years. They will not finance it for 5 years. And then at the same time, I made an example of a table that you bought it for 5K. That thing, you'll probably finance it for what? 3 months, right? So that 5,000 for a chair or for a table is a current liability. And then if you look at the 20 million for a building, which is for 20 years, right? It's more than 12 months. That's the only difference. Non-current and current, whether it's a liability or an asset, is current is within 12 months, non-current is after 12 months. If something is going to last more than 1 year, it's a non-current, whether it's an asset or liability. Anyways, so then this 5.784 billion is pretty much what's going to happen if, or pretty much is the residual, right, that will be shared by investors of this company, right? Yeah, so that is equities, liabilities, and assets, right? So that's pretty much the idea of how you can read into them. But to be controversial, about the house. In fact, there's this guy Robert Kiyosaki. I mean, a lot of people who read finance books or even interested into those stuff, like they know Robert Kiyosaki. He's famous for writing Rich Dad Poor Dad. He's famous for writing that book, and one of the things he says in that book is that your house is not an asset, right? And that ruffled a lot of feathers when he said it a long time ago, because Rich Dad Poor Dad is very old. I mean, it's a classic at this point. But he said your house is not an asset, right? And a lot of people were not happy about that. But there were a lot of nuances to it, right? It wasn't just a straightforward thing of saying, or just shitting on people and their houses and just calling their houses a liability, because everyone wants to think their house is an asset, right? I mean, most sevens they look taking, right? Abantu basebenza ukuthenga indlu, thenga imoto, and then once you're taking indlu, you're settling down with your family and everything, right? And then you think of your house as an asset. You don't think of it. But let's just watch this video before.
Rich Dad Poor Dad, I came out in 1997. I said, your house is not an asset. And it drove people nuts. It just went crazy on me, because that's a common belief. But when you can't make your house payments, you find out is the biggest liability you got. And many of the times,
it's turned out to be very much more correct than you even thought.
Right.
When you look at what's happened to home prices.
And
a big DT
I
comes along. Donald Trump comes a long way. Donald Trump used to be a finance guru, man. Would you believe it? Donald Trump crawls so Ty Lopez could walk, man. You guys know Ty Lopez. I hope you guys know Ty Lopez. Anyways, let's watch this. Then we're gonna get back to our gurus. Like these are like the first gurus angempela
in 1997, when I released Rich Dad.
Man, I was muted. I was saying Donald Trump used to be a finance guru. Donald Trump used to be a finance guru, man. Donald Trump walked so that Ty Lopez could think. He crawled so Ty Lopez could walk. That's what I was saying. Donald Trump used to be a finance guru. And these are like the OG finance gurus, if you really think about it, man. You know, those adverts on TV when lawa idlala ngo-11 ebusuku sekulela. I don't know what people remember other things on 12. I mean, the only thing I remember on 12, 350, they were advertising music. They were advertising 313, 14. I still remember that till this day. And then these finance guru videos, I used to see them. I think they were American, most of them. Got, I don't know why they're playing American stuff. ETV, they were weird, man. But they were good. They brought us Champions League. ETV is goated for Champions League. But, anyways, yeah, we were watching this. So I was saying, Kiyosaki said, house is not an asset a while ago, right? And he ruffled a lot of feathers. Let's watch this.
In 1997, when I released Rich Dad, Poor Dad, that book caused a bit of an upset because I said, your house is not an asset. So in today's world, if you want to be rich, you have to know the difference between assets versus liabilities. One of the reasons so many people are struggling financially today is simply because they're calling their liabilities assets, such as your house is not an asset, your car is not an asset, and things like that. So very simply, when I was a young boy, my rich dad taught me, he says, you have to understand a financial statement. So this
What about this quality though, bro? It's not 2008,
is
man.
an income statement, this is a balance sheet. Now, this is overly simplified. He says, what creates something to be an asset is very simply assets, cash flow money into your pocket. And a liability takes money from your pocket. So for most people, their houses are not assets or liabilities because every month it takes money to live in that house. Even those that say, well, I don't have any debt on my house, I paid it off. Look, you still have insurance, still have upkeep, you still have maintenance. So let me explain this. I'm not saying don't buy a house or don't buy this and all this. I said, if this is a house and I rent the house out and every month it's putting money in my pocket more than my expenses, then that house is an asset. Now that very same house, if it goes unrented or somebody trashes it or whatever they do, that very same house can be a liability. So a house can be an asset or a liability depending upon the most important word in business. It's called cash flow. Once again, if cash flows into your pocket, it's an asset. If cash flows out, it's a liability. Think of it this way. If you stop working today, how much cash keeps flowing in? That's from assets. And if cash keeps flowing out, that's a liability. So I'm not saying don't buy a house. I'm just saying don't call a liability an asset. And that's what makes the Rich Dad Company different.
Yeah, pretty much. Pretty much. That's how he gives it up. Yeah, this guy, he's been giving it up like this straight up for years. Um, Rich Dad Poor Dad was one of my. In fact, it was my second financial book I read. The first one was Wall Street. No. The Wolf. Yeah, The Wolf. Before I watched the movie. No, after I watched the movie. Like after I watched the movie. So I watched the movie. Then I downloaded the PDF. Then I downloaded the PDF. Man, I read that thing over holidays. I think it was December. After varsity and stuff, Sekai. I read it back and forth, and then there was the To Catch a Wolf. To Catch a Wolf. I think it was the second version because I think there's two of them. And I'm not I'm not even a PDF person. I don't read books from my phone, to be honest, because it sort of kills my neck. I know, I don't like, always ngobile ngaso sonke isikhathi. Over time ngiyakhathala. I prefer a book is better. I don't know, and it feels closer for some reason. A book feels closer and more realistic. I don't know. It's just, I guess, how my brain is wired, I guess. But yeah, is your house an asset? Kiyosaki said no. Unless it's producing cash for you, right? That's basically the basis of it. It's basically the basis of it. Other than that, there's not much. If your house produces cash, it's an asset. If it doesn't, it's a liability or cash flow, right? Because even if you paid it off, I mean, you heard him. Even if you paid it off, you still need to pay insurance, you pay taxes, you pay this, you pay that, you pay levies, right? So that's part of investing, and I guess it's more of a mentality. I think it's more of a mentality thing, investing rather. I mean, of course, you cannot monetize every house you live in, right? There will be a house or like on a nomde, right? But the way you think about it, I guess, has to shift. Instead of just thinking about it, it's an asset. It is an asset per se, but make sure it makes you money. If it doesn't make money, it's not an asset per se because he gets technical. And I think ukhuluma ngokuba technical and thina when we look at the house as an asset, we look at it as a valuable commodity, such that if it's raining outside, this is my asset. I keep this, I own this, you know. I get to say what goes on with this. So that's pretty much how we think of it when we say it's an asset. And he's speaking about it from an investing perspective to say, yes, it is, but what is really an asset? If you have two houses, that other building or that other house that produces an income for you is what technically is an asset, because technically an asset has to produce some sort of cash, right? Um, yeah, you see now I'm messing up. I should move on from this topic.